Okay. Good morning. Welcome. It's good to have you again here for the quarterly regional economic press briefing. I'm pleased, as always, to have the opportunity to talk to journalists covering our region and through you, of course, to talk to people in our district. This morning, as Jack said, we're going to focus on regional economic conditions with particular attention to job creation trends in the 2nd Federal Reserve District, which, as you know, covers New York State, northern New Jersey, Fairfield County, Connecticut, Puerto Rico, and the U.S. Virgin Islands. Following my remarks, my colleagues will provide some additional details, Erica and Jason. As always, what I have to say reflects my own views and not necessarily those of the Federal Open Market Committee or the Federal Reserve System. The statement issued by the FOMC earlier this week presents a sober assessment of the state of the U.S. economy. Economic growth so far in 2011 has been quite a bit slower than we expected earlier in the year. While jobs growth picked up early in the year, in the last few months, conditions in the labor market have deteriorated again, and the unemployment rate has edged up. Household spending has flattened out, and the housing sector is depressed. Business investment in equipment and software is expanding, but investment in corporate office and other commercial buildings is weak. Now, some of the weakness in economic activity in the first half of the year was due to temporary factors such as the hit to household income from higher food and energy prices and supply chain disruptions following the tragic earthquake in Japan. These restraining forces have abated, and thus we should see stronger growth in the second half of the year. But it's clear that not all of the weakness that we've seen was due to these one-time factors, and in light of this, I have revised down my expectations for the pace of recovery going forward. On the inflation front, the committee noted that inflation has moderated recently as energy and commodity prices have declined from their peaks. Having picked up earlier in the year, this mainly reflects the higher prices for commodities and imported goods, as well as the supply disruptions from Japan. Longer-term inflation expectations remain stable, and the committee now expects inflation to settle over the coming quarters at levels at or below those consistent with our mandate to promote full employment and price stability. In light of the current outlook, the FOMC in its statement noted that we now anticipate we are likely to keep short-term interest rates exceptionally low at least through mid-2013. At the meeting, we also discussed a range of policy tools available to promote a stronger economic recovery in the context of price stability. Further details on the discussion at the meeting will be available when the minutes are published in 3 weeks' time. And as a consequence, I'm not going to comment any further on monetary policy today. Following the release of the FOMC statements, market interest rates generally moved lower, which should help provide some additional support for economic activity and jobs. I would note, however, that conditions in the markets remain unsettled, and the equity markets in particular remain very volatile. So now let me turn to the 2nd District. The economic recovery continues to be slow, although much of the region is performing reasonably well compared to the nation as a whole. To frame our current situation, let me put this in the context of previous recessions and recoveries. While this recession lasted the longest and caused the deepest job losses and has shown the slowest employment recovery of any post-war recession for the United States as a whole, it has not been the worst on record for this region. New York State sustained fewer severe job losses than the nation during the recent recession. That's actually a reversal of past historical patterns. And upstate New York, which has struggled with sluggish economic growth in recent decades, has proven to be particularly stable. In fact, while job losses were quite severe during the previous recessions, that was not the case this time around in upstate New York. Similarly, New York City job losses were more moderate than in prior recessions. New Jersey, on the other hand, saw steeper job losses than New York and a more tepid recovery. Puerto Rico endured a serious downturn that lasted over 5 years and only now is beginning to show signs of stabilization. So the first question is, why was the downturn in our region less severe than in many other parts of the country? Well, part of the reason is that the effects of the housing boom and bust on this region's economy were less consequential. Of course, we have seen declines in construction employment, losses of housing equity, and people losing their homes. However, as in other more mature regions in the country, the housing market here tends to be less influential than in other parts of the country when population growth has been more rapid. This is particularly true across much of upstate New York, which experienced very little in the way of construction boom, home price growth, or subprime mortgage penetration. While many areas in downstate New York and northern New Jersey did experience a more significant boom and bust, the changes there were not on the same scale as some hard-hit states such as Nevada, Arizona, or Florida. Also, while the financial crisis was the key driving force behind the recession, employment in New York City was not affected nearly as much as some had predicted. Instead, it turned out that the financial sector held up better than expected. The pace of recovery in our region, though somewhat stronger than at the national level, has nonetheless been disappointing. Growth has been weak and the unemployment rate remains stubbornly high. This slow pace of recovery continued into the second quarter of 2011. As attendees at previous regional press briefings may recall, the New York Fed produces economic activity indexes, which we call CEIs, to help monitor the performance of the regional economy. Based on these measures, activity continues to expand in both New York State and New York City through June. That's the most recent data that we have available, with growth decelerating only modestly in the second quarter. By contrast, the recovery in New Jersey economy has been more sluggish, although the index for New Jersey has picked up so far in 2011, which is an encouraging development. We monitor Puerto Rico differently using an index produced by the Government Development Bank for Puerto Rico. This index shows that the recession there, which started back in 2005, well before the recession on the mainland, continues to be a challenge. The good news is that the sharp decline in Puerto Rico that persisted well into 2010 in Puerto Rico appears to have subsided. However, we don't have a clear-cut recovery yet. What we're seeing now is a series of sort of fits and starts in terms of the island's economy. As such, we really need to see the recent improvements sustained for a period of time before we'll know that we really are breaking out of this pattern of mixed signals in the Puerto Rican economy. The performance of regional housing markets continues to be important influencing the pace of recovery for local economies. Many of the places hardest hit by the housing bust have had particularly weak recoveries. Although the housing markets remain fragile, an encouraging development here is that home prices appear to be firming across much of our region. Turning to jobs, data for the second quarter of 2011 indicate that businesses in the region, on balance, expanded employment at a more rapid pace here than for the nation as a whole. Still, the number of jobs being created each month is not enough to sustain a robust recovery. Given the slow recovery in employment across much of the region, unemployment rates have edged up in most places. June's unemployment rate of 8.0% in New York State and 9.5% in New Jersey remain unacceptably high. And while Puerto Rico's employment rate has fallen sharply in recent months, it's still particularly elevated at 14.9%. One factor that remains a drag on overall employment growth in much of the region is the weakness of public sector employment. As we've discussed at previous press briefings, our state and local governments continue to cut jobs more sharply than governments elsewhere in this country. The recent reception to this trend is Puerto Rico. While the island sustained deep cuts in government jobs in 2009 and 2010, there was a recent increase in public sector employment in Puerto Rico, and that's a key reason for Puerto Rico's relatively strong job growth in the month of June. Overall, the weakness of public sector employment continues to pose a risk of employment growth throughout the region going forward. Another potentially troubling development for the region is the recent weakness in the financial sector. The finance industry, which had begun to recover late in the cycle, appears to be showing signs of expansion when we last met. Since then, the industry has lost jobs in New York City and in New Jersey. The recent job losses have been particularly significant in the city's securities industry, which has shed nearly 4,000 jobs since April. More difficulties for this sector may lie ahead, as there have been many recent announcements of consolidations and layoffs in the region's banking sector. Despite weak labor market conditions overall, some sectors are enjoying robust growth in the region. In particular, professional and business services and education and health sectors have continued to add jobs. These are high value-added services that the region can export to other parts of the country and overseas and provide jobs that tend to be performed by highly skilled people. As such, these sectors help support the broader economy and are likely to provide a source of growth for the region going forward. Now, it's difficult to say when the pace of job will pick up and by how much. As such, we will continue to monitor the region's economy and job situation closely. Now, the fact that the recovery has been so sluggish might lead you to believe that no jobs are being created at all. However, that's not true. Beneath the high unemployment rate and the overall slow job growth lies actually a pretty dynamic labor market with a considerable amount of job churning. Ongoing losses in some sectors are being offset by gains in other sectors. So what we're going to do today is we're going to take a look at the labor market in a little bit more detail to to look at this job churning for clues about how these changes are playing out across this region. So how do these changes in the labor market occur in the midst of recession and recovery? Well, first, as you go into recession, many jobs are destroyed rapidly, and there are few new ones created as the economy is weakening. This is a defining characteristic of recessions. Afterwards, during the recovery period, employment rises as layoffs subsides and business and firms begin to hire more. As this process plays out, some hiring will be in different industries from those in which layoffs occurred. For example, some auto manufacturing jobs may never come back, while healthcare providers will continue to add jobs. Thus, the point here is that employers are adding two sorts of jobs, new jobs and old jobs. Some jobs are in industries that continue to expand jobs throughout the recession or weak recovery, such as healthcare and education. We think of these as new jobs. These shifts in jobs are transformational. They are part of how our region adjusts to the evolution of technology, trade patterns, and consumer preferences. In addition, now that we're in recovery, broad industries are beginning to add jobs to replace earlier layoffs. This includes things like administrative support in wholesale and retail trade. We think of these as old jobs because they restore their industry's share of jobs as economic activity picks up. The two recessions prior to this most recent one saw an unusually high share of new job creation in expanding industries rather than rebounds of old jobs. Research done here at the New York Fed documents this for the nation and New York. The preponderance of transformational new job creation may have reflected the fact that the recessions that we saw in 1990-91 and 2001 were relatively shallow. In addition, employers may be more likely to use recessions as an opportunity to make their operations more efficient. For example, employers are less likely to use temporary layoffs when they reduce staff during downturns, and more likely to use temporary service agencies or outsource part of their operations when they need to expand. Now, so far, the current recession does not follow the pattern of the last two downturns. In New York and New Jersey, as well as for the nation as a whole, job creation during this recovery has been actually fairly evenly balanced between new jobs and old jobs, instead of heavily weighted towards new jobs, as was the case in the prior two recessions. If this pattern holds, the recovery process could have a higher share of unemployed workers returning to jobs similar to those that they left during the downturn. That could be promising for the adjustment process when the recovery gathers strength. There is some variation within the region, though, in the areas with higher preponderance of new jobs are undergoing more rapid transformations that could position them well for growth going forward. As a result, these areas could face a particularly strong need to retrain and educate their workers. In order to prepare our region to be as competitive as possible, I think it's important that policymakers, firms, and workers need to accurately gauge which industries and jobs will grow the fastest in the future. Given the trend over the past few decades, it's no surprise that new jobs are being created across the region and the nation are likely to be in those industries with a high share of workers that have a college education. Thus, this just points out that education and worker training is likely to continue to be very important in maintaining the economic vitality of our region going forward. So let me sum up. The recovery in our region continued at a slow pace during the second quarter of 2011. While overall job growth has been sluggish through the recovery, we find that a great deal of job churning is occurring beneath the surface throughout our region. So far, this job churning is about evenly balanced between old and new job creation. The evidence to date is pretty clear that these new jobs on balance are in industries that employ workers with higher levels of skill and education.